Welcome back to another episode of Equity Mates, or should I say, welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to break down your barriers from beginning to dividend. If you're just joining us for the first time, welcome. Now, while we're licensed, we're not aware of your financial circumstances. Any information is for entertainment and general advice only. What do you reckon?
Well, Bryce's brother Bruce joined us today.
Yes.
AI voice.
AI voice, yeah. So if you've just joined us, I've been using ChatGPT to help with some of my intros, and we've taken it one step further. Producer Sasha has taken to the AI cloning tools and thrown in my voice and asked it to then do the Equity Mates intro that I've been doing for years, and that's what it spat out. I reckon it sounds like the guy who does Case File. Have you listened to that?
Yeah, I have, but not well enough that I could place the voice. It's reassuring to know that AI can't quite come for our job yet.
Yes, although there is another one that Alf was showing, another teammate colleague in our office, and it was like super realistic. So Sasha, maybe we'll throw it into his.
You know the Anthony Bourdain story?
Yeah.
Yeah, that for people unfamiliar, Anthony Bourdain died halfway through narrating a documentary, like a travel documentary, what he was known for. And the family agreed with the production company that they could use AI, train it on his voice, and then finish the narration. And apparently it was seamless.
Yeah. It's pretty crazy. But I did have the same sort of takeaway. If that's where my voice is at now, at least I'm not going to get done soon for saying something that I didn't say. That's my biggest worry about it.
Deepfakes?
Deepfakes. Yeah. It's going to cause a lot of litigation down the track, I reckon.
Well, there will be ways, like there will be billions of dollars in verifying and all of that. And someone smarter than us, more technically savvy than us will figure it out. It's like the cybersecurity industry. It's like every new threat creates a new business opportunity and
Until it happens. Anyway, welcome to the show. As we said as ChatGPT said.
You just don't want to be the test case where people realize, this is something that's what I mean. A problem to be solved.
Yeah, exactly.
It's all right. We're nowhere near big enough to be targeted.
Touch wood. But yes, if you have joined us, my name is Bryce, and on the other side here, I've got Ren, and this podcast is all about following our journey of investing.
Sorry, we didn't.
Now, I should say the disclaimer properly. So any information on this show is general advice only. We do not know your financial circumstances, so please take everything we say with a grain of salt. Now, Ren, today we've got a listener call coming in from Alan. Very excited to get to that. We're having a look at the merge between the UFC and WWE and the new company that is just listed off the back of that. But to kick off, news, portfolios, it's all happening. I did a bit of an update on my portfolio last week. You've got an update on yours this week.
Yep.
But has anything caught your attention outside of that?
Well, before we get into the investing stuff, just something I learnt, that I found interesting. It was from a study in the 90s, so this isn't new information, but it was new for me. Did you know that if all cancers were cured tomorrow, like we just cured cancer completely, the average American's life expectancy would only increase by 3 years?
I did not know that. That is surprising.
Yeah. Well, just like how devastating cancer is, you'd think there would be a greater impact on life expectancy if we solved it.
Yeah, I guess it goes to show all of the other things that you do to your body that don't result in cancer, but
I mean, I think it's more like if cancer doesn't get you at that, like as you get older, if cancer doesn't get you, something else will.
Fascinating. So what's the takeout there?
I don't know. I just found it interesting. You should see producer Sasha just making a face at us, just being like, what are you guys talking about? So with that in mind, let's get to the investing stuff. So I think what I want to talk about today is there are two companies that have caught my eye. One that I have recently bought and one that I would never buy. But is quite interesting, so I'll get to that. the clear caveat being here that these are decisions that I've made for my portfolio with my investing goals and my risk tolerance and my often faulty analysis. So, do your own research and don't take what we talk about as personal advice for your own portfolio. But with that said, I think the starting point here is I feel like really rock solid with my core portfolio.
Nice.
And my
Good on
core
you.
generally. We literally just wrote the book on it.
Yep.
Don't Stress, Just Invest, available wherever you buy books. And so for me, like, that is automated, that's ticking away. There's not much to talk about there. And it's just like, it's good.
Yeah.
And so now I'm really taking the time and applying what I've been working on with my mentor, Andrew Page, and really just trying to find high quality, long-term compounders, and then trying to do a bit of valuation work and get into that. So Bryce, a company that I've bought recently,
Yeah.
and by recently I mean in the last few weeks,
Okay.
Resmed.
Sleep apnea.
Sleep apnea.
We did an episode on it for last year's summer series or the year before, I remember, when we were at the WeWork office. Fascinating company.
Yeah, now for people unfamiliar, sleep apnea is it's when you have obstructed airways when
Yep.
you're sleeping. It's often it will go undiagnosed and people will just snore their way through life having poor sleep. I actually did a sleep test earlier this year. My dad has sleep apnea, and so I did a sleep test. Apparently, I stop breathing 10 times an hour, an average of 10 times an hour when I'm sleeping, which
Wow.
doesn't sound great, but apparently it's like mild sleep apnea. So I've got it. Did a test with a CPAP machine. Haven't done anything more. Anyway, just a little insight into
I thought you
life.
took that back.
I did take it back.
Oh.
Yeah.
So it's not, you don't need it?
Well, they would say I need it. I'll get one eventually. Just gotta get the.
Oh, so they did say you should take this.
Well, I mean, yeah.
Right.
They
But
got-
you were like, nah.
They just like started really giving me the hard sell, and it all got a little bit too much.
Yeah,
and I
fair.
wanted to, and they were like, just like you have to have this one, and it was like, I didn't get the choice of options.
Yeah,
I didn't get a
yeah.
chance to ask questions, and I was
Yeah.
like,
Nah.
I'm just gonna
Too
do
late.
my
Later
research,
on.
and then
Yeah.
I've kicked that can down the road. But
Okay.
yeah, it's in my future. Anyway, it's estimated, these are American stats, but it's estimated that 20% of the American adult population have sleep apnea, and that 90% of people that have sleep apnea are undiagnosed. So it's that's sort of the state of it. Resmed is an Australian company, one of the great Australian health tech companies, along with CSL and Cochlear, that have really taken on the world in this space. And Resmed is now based over in the States, and they make CPAP machines. And Resmed for years has been a market darling. So for most people listening to this, they're probably familiar with the company. But the reason that I bought it is because it fell a third in the last month. Its share price fell a little over 33%.
Yeah, it's been hammered.
Yeah.
So from the 3rd of August, we're recording this on the 14th of September. So 3rd of August, it was at $33.85. It is now trading at $23.25, down 31%.
Now, in the last month, it reported its earnings for the year. It reported an 11% increase in profit. Why did it fall 30%?
It fell 30%, Ren, because of the craziness that is coming out of Europe and the drug that is taking on the world, Ozempic, which is a drug that is created by a company called Novo Nordisk. And investors obviously see this as a major threat to Resmed. The reason being that there's the perception that largely sleep apnea is driven by obesity. Well, not a perception, but a lot of obese people have sleep apnea, and Ozempic is a drug that contributes to significant weight loss. And so by curing or getting rid of obesity, then there's not going to be a market or as a bigger market for Resmed. So that's the theory.
Yeah. And so a lot of these stocks that benefit from the trend of more and more obese people are getting a hit because of Novo Nordisk. Novo Nordisk, a Danish company, now more valuable than Denmark's GDP.
Yeah, the wonders of pharmaceuticals.
Yeah. So that's the thesis. That's why a lot of the market is selling Resmed, because they're worried about people, the
market's gone.
Smaller market, smaller total addressable market. I think those fears are misplaced, and I think the valuation is compelling. That's why I bought it. For me, it's like, and maybe I'm missing the magnitude of Ozempic, but it's the number of obese people and the trend. Novo Nordisk might slow the growth. I don't think it's going to reverse the trend. And even if it does, like the opportunity for Resmed and for Fisher and Paykel Health, and I think Philips also makes CPAP machines, like these players that are sleep apnea, is to get the 80 to 90% of people that have obstructive sleep apnea today and are undiagnosed to a doctor and to a sleep test and getting them diagnosed, rather than worrying, like if that becomes 60% of people that are undiagnosed because the market gets smaller, that's still like there's a lot of green fields there. Blue sky, green fields, whatever. And so for me, it's like the concern about a shrinking total addressable market when like the market is so untapped at the moment feels over-exaggerated.
Yeah, well, this reminds me of that conversation we had with Ricky Sandler last year, leading into Stone Hearts and Minds, where he kind of looks for these opportunities where the market oversells or overestimates what the negative impact on a business is, and as a result, probably oversells. So
Well, it reminds me of Simon in the office here, and I bought Meta, Facebook, in November last year when it was just like at a stupidly cheap level. So we're pretty happy about that, and continue to remind you guys. So working with Andrew Page, my mentor, I've been working. He does like this back of the envelope, quick valuation methodology, sort of finger in the air to get a sense of what would have to be true for a share price to be compelling at the moment. So I did that with Resmed. So let me just talk you through it. Now I use Ticker for this data. Ticker, tikr.com/equitymates. If you want to check it out, they have the US data for Resmed. So these are US numbers. So the share price, $149. The earnings per share, $6.44. Last year, it grew 11%, those earnings. Over the last 5 years, it's grown at an average of 13% a year. So I've sort of, with those numbers, sort of modeled out two scenarios. Let's say the $6.44 in earnings per share continues growing at 13% over the next 5 years. That'll mean $11.87 in earnings. So it just continues doing what it's done recently. And you give it a 20 price to earnings ratio. Right now it's a bit over that. So you say the price to earnings ratio comes back in a little bit. That'd almost double its share price, $298. Sounds pretty good. But what about if all of these people worried about Ozempic are right and Resmed's growth really starts to slow because all of these people that have sleep apnea get fit, get skinny, don't have obstructive airways anymore, and throw the CPAP machine in the bin. Let's say it just grows at a bit over inflation. Let's say it grows at 5% for the next 5 years. That takes $6.44 to $8.22 in earnings per share. And let's say because the market hates it, it's like this company isn't growing. It's getting smashed by all these hot, fit people running around, not with obstructive airways anymore. And it gives it like a 15 price to earnings, which is like what you'd give a slow growing company, mature company. That gives it a $164 share price. So around about what it is today, a little bit higher than what it is today. So for me, like that range of outcomes is compelling. And that's why I bought it.
Nice. Is the bear case compelling?
That, like, for me, everyone that is currently using a CPAP machine, I think is very unlikely to stop using a CPAP machine.
Yeah.
So it's like, I don't see a world where it goes backwards.
Yeah.
It's just like maybe the world is they stop getting new patients and all they're doing is just selling masks and consumables to people that already have the machines. Yeah. And I could be wrong. Like, I've got plenty wrong. But for me, it was like, that's interesting enough that I put some money into it.
So how do you think about weightings with this stuff?
Small percentage of my overall portfolio.
But like, do you actually think about it, or do you just go, I've got some of this cash, I'm going to put half of what I've got available, or do you actually do you do the maths on it?
No, I don't like, I'm not worried if it's like 5 or 10% of my portfolio. But I don't have a heap of lines of stocks. Instead, what I try and do is put more into existing ideas that I think are still compelling. So, I've put some into this. If I think it's still compelling, if the thesis is playing out, and it doesn't get too expensive, I'll put more in and build a position over time.
Yeah.
But, my biggest individual stock holding might be like 10% of my portfolio, and then everything down from there. What I have done recently though is cleared out some of the tail of just stuff where it was like,
$500 here and there.
Yeah. And it's like, is this gonna, even if
what's the point?
Exactly. Yeah. But the point is, if you believe in it and you want to build a position over time.
I think that's the key thing, and kind of what I'm trying to get at here. It's kind of like, if the bull case does kind of play out, then there's still a lot of opportunity for this thing to grow, and you want to make the most of it. So it's in my mind, when I'm doing these satellite positions, it's important to be like, I've got this money available now, but this shouldn't just be the one stop. I'm just going to put it all in, because if you're going to put $1,000 or $2,000 or whatever, it going from 149 to 164.
Yeah. But that's, for me, that was the bad situation.
And I know. Yes.
So look, it's a company that a lot of people know about, and it just feels like the recent sell-off, if you don't believe the Novo Nordisk hype and all of that stuff, potentially an opportunity. So anyway, that's one company that I have bought. I said there was a second company that I think is compelling, but I'm not going to buy.
Oh, yeah?
And that is GQG Partners. Does that name ring a bell?
It does. We've had the CEO and founder on, but the name escapes me. But again, we had him last year.
Yeah, Tim Carver. So we spoke to him, and we'll include the link to that interview in the show notes if you want to listen to it.
The US-based global fundy.
Yeah, so US-based fundy listed in Australia. And how's this? At the end of 2017, they had $10 billion under management.
Mm-hmm.
Fast forward, 5 and a bit years? $92 billion under management.
Wow.
And we know that when we're talking about fund management businesses, not the funds themselves, but fund management businesses, the way that they make money is assets under management, and they get a percentage of that asset under management. And we know when we're talking about funds management business, they make money in 2 ways. First of all, by growing their assets under management, and they take a management fee. And then secondly, by outperforming the market and getting a performance fee. And growing your assets under management from 10 billion to 92 billion in 5 years is pretty compelling.
It is compelling, but then you look at their stock price of the last 5 years and it's down 27%.
Yeah. Well,
What the hell?
now there's a reason that I haven't done any more DD than this, and there's a reason why. Do you want to guess the reason why?
Magellan.
Yeah, Magellan. I don't want to speak for you, but I got so burnt on them.
From investing in the company.
Yeah, so I invested in Magellan, the parent company. The funds keep doing well, but the parent company then, as much as these fund managers have really compelling stories as they're growing their assets under management base, it goes the other way very quickly as well when they start losing assets under management. And Magellan lost a mandate from a big UK-based fund or asset manager, and that lost tens of billions of dollars from their fund. And I think they've gone from over 100 billion under management to like 60 or something now. Something like that. Yeah. rough. Yeah. Don't have the numbers in front of me, but that for me has made me very nervous about companies where your revenue driver can be taken away with factors outside of your control very quickly, if that makes sense.
My biggest learning with that whole scenario was that I just didn't act anywhere near quick enough. Soon as we knew the thesis was broken, like we spoke about the thesis for that time and time again. And then as soon as it was broken, I was like, nah, should be right. Yeah. She'll come good. Yeah. And it was just a big learning, big learning. Yeah. But it's fascinating to see, when Magellan were going through that phase of Hamish Douglas out there being the Australian Warren Buffett, and conferences and funds were flowing in at an extraordinary rate, and they would, similar to what GQG were doing with funds under management increasing rapidly. Their share price reflected that, went from, I think it hit highs of about $60. Really interesting to see that hasn't played out with GQG. The market obviously thinks something's not quite right. Yeah. Given that they've been able to almost 10 times their FUM, and it's down 27%.
But to be clear, it only listed in October 2021.
Yeah.
Yeah. So,
which I think was when we spoke with them.
We spoke to Tim pretty early. Yeah. So anyway, two companies that have been on my mind recently: GQG Partners and Resmed. Oh, one stat that I didn't say about Resmed. So the sleep apnea addressable market is estimated globally to be approximately 900 million people, which is crazy when you think the world is, 8 billion? Yeah, so 900 million people are estimated to have sleep apnea. Currently, across all providers of CPAP machines, only 16 million people are on CPAP devices. So when I was talking about the green fields earlier, blue sky, whatever you want to call it, that's it. And if Ozempic takes that 900 million and makes it 500 million, halves the number of people because everyone's fit and hot and taking weight loss drugs.
Invest in Ozempic.
Well, invest in Ozempic, sure. But that's still the growth opportunity from 16 million people on CPAPs to hundreds of millions is huge. Yeah. So everyone, go and get sleep tests and then get a Resmed device. Thank you.
Resmed just need to engage in a public education program.
I reckon they would do a lot of that.
I've never seen it. Have you?
No, and I was about to say I'm not their target market, but I should be their target market.
It sounds like a lot of people should be.
Yeah.
Like 900 million people.
Resmed should pay us to do a PR campaign for them.
Anyway.
But anyway, look, I think two interesting companies, two to put on your watch list and do your own research on. But I think I've waffled enough, Bryce.
Feel free to keep going.
All right, Bryce. Well, there has been some big news in the business of sport world, the business world that relates to sport. And that is a new company has listed on the share market that we want to talk about because it's been a real trend the last couple of years. The number of sports-related businesses that are listing on the share market is growing, which is really exciting because sports as an asset class has just outperformed everything else.
I know, Ren.
You say that so sincerely.
Yeah, well, it's just one of those, like, we spend our time trying to figure out how we can get access to parts of the market that are inaccessible for retail investors, for us. And you see all these news headlines of, it's a billionaire's playground.
Well, yeah, but obviously, like, the way to get access to this asset class is by the Dallas Cowboys.
Exactly.
But, the good news is
it's changing.
Yeah, it's changing. It's changing.
There's more and more listing opportunities.
Yeah. And you've been slowly acquiring a position in the Brisbane Broncos. For people unfamiliar,
Slowly acquiring. I own half of that thing.
Well, News Corp own the other half. So, yeah, the Brisbane Broncos, Australia's largest rugby league team, probably, or maybe one of the largest rugby league teams. They are listed, ASX BBL. They've almost doubled their share price in the past 5 years.
Nice. Well, that's because of my large positions that keep going in Ren.
Well, I always thought that they had a reputation as just like a nothing stock. But
well, I remember I guess when we looked at it probably 5 years ago, I remember we did the industry deep dive on sports, the performance wasn't great, but kudos to them.
Yeah. Anyway, we're not here to talk about the Brisbane Broncos, although I am backing them to win the premiership this year.
Okay. Over the Panthers.
Yeah. Panthers-Broncos final. You almost lock that in, write that in stone. I mean, the three-peat for the Panthers would be interesting.
It'll happen.
You reckon?
Yeah.
Should we put a bet on it?
Yeah.
What's the bet?
That the Panthers will win.
You loser.
If the loser has to come on and sing the theme song for the losing team.
I don't know. Do they have?
I don't
theme
know if
songs
rugby
in
has
rugby?
songs. I've never seen them
around like
AFL.
I think Souths do, but
I don't know.
We'll just bet for prize.
Yeah,
Let's keep going. No one cares about our bets. But over in the US, a big sports merger and new listing has taken place that we wanted to touch on. TKO is the ticker. It is the merger of the UFC and the WWE.
Yes, World Wrestling Entertainment.
Fake fighting and real fighting have come together. TKO, you get the ticker as well?
Yes.
Yeah? Nice.
Yes.
Now, let's talk about how it came about in the company.
So it listed in New York, as you said. It's controlled by a company called Endeavour Group, which is controlled by a guy called...
Not the Australian...
Not the drinks company, which I did sell during the week. I think I told you I was going to do that in my update last week, get rid of it. It was in my portfolio, I got rid of it.
Fair enough.
So Ari Emanuel.
Does the name ring a bell for you?
Ari Emanuel.
Yeah.
No.
So have you watched Entourage?
Yes.
Yeah.
Oh,
so
Ari.
Ari Gold
Ari Gold
is based on Ari Emanuel,
Ah.
like a high-flying Hollywood super agent,
Ah.
temper, all that stuff. And then Ari Emanuel's brother, Rahm Emanuel, was senior advisor to Barack Obama and then became the mayor of Chicago.
Wow.
So the Emanuel family have done pretty well.
Pretty
for
well.
themselves.
Wow. Now that makes sense. So they formed TKO, which, as you said, is WWE and UFC. Together, they're going to be putting on 350 live events worldwide, reaching over 1 billion fans. And it's really positioned to capitalize on the growing demand for premium sports content and live events. And there's big money. As everything goes to streaming, and this is something we've spoken about offline, Ren, as everything goes to streaming, the one thing that remains in terms of like TV is live sports.
Yeah, although that's going to streaming as well now. Like ESPN had that big fight with Charter Communications last week because they're doing direct-to-consumer. The NFL, which has had direct-to-consumer outside of America for ages, now have NFL Plus. All these streaming services just putting plus on the end of their names. KO was selling the UFC as even before the paywall.
True.
Like you could just buy it one off. Like even sport is now leaving the pay TV world.
True.
And that's why cable is just, it's
dominant.
Done. No, cable's done.
True.
Like what have they got? Sport was the only thing they had.
So the WWE signed a $1 billion rights agreement with NBC's Peacock streaming back in 2021, which will be up for renewal in 2026. And this company is expected to, I guess, pull in significant TV rights deals. They expect the merged company now to generate more than $1 billion in annual earnings. So it's a pretty interesting merger, and I think a opportunistic one from Ari.
Earning $1 billion, like it's only $8.5 billion market cap at the moment. So if it can generate more than $1 billion in earnings, I assume that's over time, not this year. There's some growth
Pretty
there.
significant.
Yeah. The UFC was in Sydney recently, and it's like a global phenomenon now. Like, I don't think either of us are super into fighting. Like,
No, I don't engage with the UFC or WWE at all.
Yeah, but like more and more of our mates are messaging us on group chats about it, and it's growing. Yeah.
Here's an interesting one from Ari about why he's done the deal. He says, "We think the world is going to have more free time than ever with AI." So thinks that the weekends are going to be like in college. It starts on Thursday night and you need experiences, and reckons that through his company, are going to be providing experiences. The UFC has been a cash spinner for Endeavour, the controlling company of TKO. It has an estimated standalone enterprise value of $12 billion. And after Formula One, UFC has experienced the highest growth in attendance of any sport over the past 5 years, according to Morgan Stanley.
The idea that the idea we're going to have more time because of AI and that's going to unlock sport as a pastime. It's like sport has been the one constant, regardless of how much we worked. When we worked 7 days a week and we didn't, there was no such thing as a 5-day work week or an 8-hour work day. Sport was still a constant in everyone's lives. I mean, I guess we'll have more capacity for sport. But anyway, I think the investment thesis for TKO, if you're going to invest, should be more about the growth of these sports and what they will be displacing rather than AI related.
Yeah, I know.
But I think, so that's a really interesting listing, but the interesting thing is it's one of many mergers and listings that we're seeing in the sports space that for people who are interested in investing in it, it's worth paying attention to. And the next one is one that I know is close to your heart and one that we have frequented, which is Callaway, the golf brand, merged with Topgolf, and they are now a listed company together, Callaway Topgolf.
I mean, as what? Suppliers of...
Well, as like a golfing giants.
So they're...
Hold on. Before you start criticizing it, do you want to just explain what Topgolf is for people?
Oh, Topgolf, once you start, you'll never stop.
The driving range of the future?
Well, yeah. So it's taking the driving range to the next level. Traditional driving ranges have nothing but an open grass field in front of you with distance markers. Topgolf is now designed for, I would say, for your non-golfers, where you play a lot of virtual games. There's still a driving range, but you hit the ball, it will track the ball, and you can play different types of games with your mates. Then they include DJs, they include food and drinks, and it's just a great social way to enjoy a night on the driving range. Now they do have...
The perfect date night spot. Bryce is trying to convince his wife.
Yes. Well, unfortunately, Ren, there is not one here in Sydney that is accessible, if at all. We were lucky enough to play a few over in the States when we went, and it is a lot of fun.
Although if we had a deep-pocketed private equity backer, we often talk about buying the Moore Park driving range and turning it into a Topgolf would just print cash.
Off. It would print cash. It is an expensive thing to do. When we were in the States, I think it was $60 USD an hour. That could be split between up to 6 people, but still, and then the food and drink on top. I remember walking out thinking it was pretty expensive. Yeah. But if there was one here in the middle of Sydney, it would be a money spinner. It would be a money spinner. Anyway, so that's what Topgolf is. It's, you've probably seen it on TikTok or Instagram, people getting drunk and falling into the nets and those sorts of things. Have you seen those?
Our TikTok algorithms are quite different, I think.
Okay, cool.
I don't get a lot of golf content.
Have they I don't think they've merged with Callaway. I think it's
Yeah.
a partnership.
Yeah, they've merged. The merged company is called Top Golf Callaway, or Top Golf Callaway Brands. Callaway's actually been on a bit of a acquisition streak. Is that what you call it? An acquisition. They've done multiple acquisitions over the last few years. We did a write-up in our Thought Starters email, and we'll include the link to it on our in the show notes here if you want to read more about it. But I think it was something like 5 acquisitions over the last 5 years, and Topgolf being the biggest of them.
So Topgolf Callaway Brands is the listed vehicle, MODG, which has underneath it Topgolf and all things Callaway.
And a few other
And
companies.
whatever.
But yeah. They're the main 2.
I wonder why they kept Topgolf in the name.
Because it's
the new
the
thing.
hype.
It's
It's
the new
hot.
thing,
Like
yeah.
yeah. Speaking of sporting tournaments and broadcast rights, aren't Topgolf doing a golf game? Like a golf competition?
I don't actually know if it's at Topgolf, but there is a driving range-esque virtual golf competition that is called Future Golf or something like that, led by Rory and Tiger Woods. I reckon they're going to regret this because it seemed like it was a rash decision made at the time where Live Golf was picking up steam, and there was a lot of frustration around, the fact that the traditional golf wasn't attracting younger members, and so they came up with this concept of standing in a driving range and some of the big hitters coming in and competing against each other. But I just don't. I don't know. I find it hard to see how it will be that engaging to watch, but we'll have to find out. I think it's launching next year.
I'm just trying to Google it and I can't find anything. But if you're interested in reading more and maybe correcting some of our stuff here, the write up in the
it's called TGL, a golf league. Yeah. Yeah, it looks so lame. Anyway.
Fair enough. Well, Bryce will not be not be watching that. So I think, look, it's an exciting time to be interested in the sports space. A kind of recent merger with Topgolf Callaway, a new listing with TKO Group, and then there's obviously all the existing listed vehicles. Formula One as a competition is listed through what's the Liberty Media, the incredibly complex structure. There are the teams, the Brisbane Broncos we mentioned. Manchester United is listed over in the UK, although if it gets bought, it might become delisted, but right now it is listed. And then there's even stadiums, like Madison Square Garden as a stadium is listed. So there's heaps of opportunity in the sports space. I haven't invested a lot in it, but I'm very interested in watching it.
Yeah, well, we'll exit Equity Mates one day and buy a sports team.
My dream in life is to be Jeffrey Edelston, and not because I want to be a disgraced doctor, but because he owned the Sydney Swans I think in the 90s. He bought the Swans from the AFL, and then eventually he was disgraced and he had to sell it back or something. But my dream in life would be to own the Sydney Swans.
Yeah, fair call.
Franchise value alone. They're like Dallas Cowboys of Australia, they would call it.
No. All right, well, we'll take a quick break. And on the other side of this, we're going to give Alan a call, one of the Equity Mates community members, to discuss fractionalization and in dollar cost averaging. Hello, Alan.
G'day, mate.
Alan, I'm also here. This is Ren. How's it going?
Good, Ren. How are you? The myth, the legend, that is the Equity Mate boys.
That much of a myth?
Yeah, I know. Or certainly not legends, but good to chat.
Definitely legends. Legends.
So, got a couple of questions through from you. The second is around dollar cost average. So talk to us. What's the barrier?
I'm a big fan of dollar cost averaging, and all the statistics sort of suggest that you know, the experts, most of them can't beat just the regular all-encompassing market. So why try to beat the market when you can just simply, you know, sit on a wide all-encompassing ETF and get the market return? But looking at different ETFs that you can buy, like the A200 ETF for the top 200 in the ASX, it is at the moment it's around about $120 per share of the ETF. So for a regular mere mortal like myself, if you wanted to say dollar cost average, maybe say $200 a week or a month or something sort of like that for a regular person, it kind of means each time, say you're $200, even $200 a week, at that price point of around $120, you're only ever buying one share, and then you're getting a lot of change left over.
Yeah.
And so really, whilst you might maybe, you know, one week you buy it at $120, maybe the next week you buy it at $119, the next week you buy it at $121. I mean, there's a slight up and down there, but really you're just getting one share at around the same price with a bit of change left over. And so I feel like that's not really getting the full experience of dollar cost averaging, where you really want to be spending the whole $200. And so at 1 week when it's more expensive, you're buying less of it. And then on the weeks where it's maybe a bit cheaper, you're buying more of it, and your $200 is getting employed every week, rather than buying one whole share with a slight difference in the price going up and down each week, which brings in either you have to spend a large amount of money to be buying more shares when it's cheaper and less shares when it's more expensive, or to get the full effect of dollar cost averaging, I feel like you need a broker that's offering fractional shares, so that every week your full $200 is getting employed, and you're getting that full benefit of buying more when it's cheaper and buying less when it's more expensive. And from what I can find, Sharesies is the only sort of Aussie broker that now does fractional buying. And I feel like fractional buying, especially, you know, on an ETF that's at a higher price point, is really key to get the full effect of dollar cost averaging. So again, you're buying less when it's more expensive, and you're buying more when it's cheaper.
Yeah, it's a great question, and one that, you know, I have this problem as well with the setup that I've got through Superhero. It's not fractional. And so every time I'm putting money in, and, you know, I'm definitely not fully investing the amount because of this, you know, and you are left with change. And then I make a conscious decision every month to then go and invest that change. So you're never going to get it perfect unless you do fractional.
The other thing is, as you go up the dollar amount, like the problems still
it still remains.
exist.
Yeah, unless you're in like big amounts.
But you're still gonna have you're still gonna have stuff left
It's never
over,
gonna be
and
perfect.
like potentially it means you're buying more when the price is up, buying less when the price is down. Then you're faced with this dilemma: do you get the imperfect dollar cost averaging at no brokerage with like a Superhero, or do you pay to get it perfect with Sharesies?
Yeah.
Exactly. Yeah, Superhero is great because there's no commission on ETFs, which is great. But then again, each time you're only buying whole shares and having that change left over, and then you've got to try and do you try and time the market when you buy your extra one every couple of weeks with the change you get, and then you're kind of going against the sort of perfect dollar cost averaging thing because you're having to time the buy with the change, or then you pay a little bit, but with Sharesies you get the fractional and you get your full, you know, allotment invested every week. So I've been with Superhero for a couple of years now, and have been just dollar cost averaging that with the no brokerage, but I've actually set up Sharesies in the last few weeks just to experiment and give their fractional buying, their auto investing a go, and see the difference, you know, and see if over time it sort of works out better, even though there is a small brokerage. It's something I'm just doing $5 a month, and that gives you up to $1,000 of auto investing, which is plenty for me anyway a month. So that small price to pay I feel more confident, better knowing that I'm getting true dollar cost averaging and getting my, my full $1,000 a month broken up into like 250 lots a week, fully invested.
Here's a strategy that has tax implications, but
Here we go.
could also work. Depending on what you're investing in, maybe outside of the ASX 200, although I'm sure there are listed products in America that give you access to the A200. Like, you could go through, you could go through the, like, Stake, for example,
or superhero.
Not fractional though.
In the US?
I don't know. I'm not sure.
Is that where you're going with this?
Yeah. So I'm saying, like, if you go through Stake, for example, buy US listed ETFs, which gives you zero commission and can be fractional, and you're going to get the same, like if you're doing into a S&P 500, if you're doing it into a European markets, if you're doing it into Asia, they're all going to be listed on US markets. So you could dollar cost average that way into a...
You wouldn't do Stake because it's not auto invest though.
They don't have auto invest. That's true.
Yeah.
Yes.
You're
Stake
also
doesn't have auto invest, but Stake has fractional.
Yeah,
Definitely.
Fractional for the US, not for
US.
Australia.
Yeah, not for Australia.
I think only Sharesies does fractional in Australia. I haven't looked at like the eToros of the world and stuff like that. But Bryce, your strategy, then you just got the currency stuff.
Yeah, as I said, it comes with. I'm not against the currency stuff at the moment. Like, this Aussie dollar is pretty damn weak, so.
Yeah,
like,
and if it's over long term currency,
buying into it, obviously you're getting less, but yeah. I think though that if someone's listening here and then is kind of getting put off the idea of DCA because it's not going to be the perfect solution, I think the key message really from us is that at a minimum, if you're getting sort of the 90% of it right, which is automating from your bank account into a broker and then automating a consistent investment over every week or fortnight or month, like that's the behavior you want to build. That's at least that means you're buying at a consistent rate, whilst it's probably not theoretically the true dollar cost average. When Ren and I were talking about DCA 5 years ago, like it was further away from what it is now because we didn't even have automation back then, and you had to pay brokerage and so
and they just sort of killed profits with what brokerage.
Exactly, $20 through CBA.
For the regular punter,
yeah.
So I'll tell you how I do mine. The ETF where I really feel this is the Vanguard FTSE Asia X Japan, because I try and put $100 into that every pay cycle, and its share price is $69, so about $70. And so every time it's like $30, it's just sitting in there. That gets annoying. So then every now and then I'll go into it and I'll rebalance. So if the Asia one is far less than some of my other geographic ones, I'll top up the Asia one, knowing that, like, you know, you've kind of screwed up the perfect timing of DCA. But for me, it's like, you know, we're looking decades ahead now. The main thing is just having sort of equal exposure to different parts of the world.
Yeah.
But what I'll also do is the money that gets left over in my superhero account, I'll then treat that as the money that I can put into thematic ETFs. I've put some into Hack recently and stuff like that. But it's like that's not part of my regular DCA plan. I just use that as extra money to either top up or to invest in other things.
You almost got like a mini core and satellite going on.
Yeah.
With your ETFs.
It's like, oh, then I get to invest this into something that I want to invest in or that I think is interesting that's outside my just consistent automated DCA plan. But, you know, like perfect world, all of these brokers in a couple of years introduce fractional Aussie. And I wouldn't be surprised if they do.
Yeah, it's pretty competitive. But yeah, like you say, I think for most people, it's just about getting into the habit, or if you're bad at getting into a habit, putting it on auto invest and auto transfer, you know, your money across from your bank account into your brokerage account every month so that it's all automated. You don't have to think about it. You don't run the risk of, like, you know, skipping out and being like, oh, actually, you know what, I'll use that money this week for a holiday instead of putting it into my DCA. Yeah. So like getting it automated and it just ticks away in the background, and
DCA
any
go
of those
away.
Yeah, any of those minor technicalities on a true perfect DCA are kind of irrelevant over a long term.
Yeah, if this is the problem you're facing, you're doing a lot right.
Yes.
Yeah, it's already pretty good. So.
And
yeah.
I bet just like we've seen change over the last 5 years, as you said, Alan, like these brokers are always improving and creating new products. And so, auto invest wasn't even a thing 2 years ago, 2.5 years ago, or as prolific as it is now. One does it, they all do it because of the competition. I wouldn't be surprised if at some point we start seeing auto invest and fractionalization of Aussie at some point, like, as technology improves. And then we can all really sit back and know we've nailed true DCA.
Yeah, definitely. There's a lot of competition with the brokers. So I mean, if they follow I've gone from Commonwealth to Westpac to Self-Wealth to Superhero and now to Sharesies, and they're like, when's this guy finally ever going to
I know, that's actually kind of my journey. I was like ComSec, I had NAB, then I went Self-Wealth because they were the first to really go low brokerage, and then the Superhero and Stake.
Superhero.
Got them all. Don't use them all, but
collect them all. Yeah.
Well, keep us posted. I feel like we was only speaking to someone last week about Sharesies and their fractional offer. So obviously something that a number of the people in the Equity Mates community are looking for. So yeah, keep us posted. We'd love to hear how it goes and share it with the community I think everyone will be able to benefit.
Keep up the good work. We love the podcast.
Nice one, man. Appreciate it.
Thank you.
Have a good
Speak
one.
soon.
Support. Take care, gents. Thank you. Bye-bye.
It was great chatting with Alan, and we love chatting with our community here at Equity Mates. If you'd like to submit a question, you can hit us up at contact@equitymates.com. All right, Ren. Well, before we go, we have an awesome interview coming up this Thursday with Saurabh Mukherjee from Marcellus.
Yeah, epic.
About all things India.
Yeah, got us so excited about investing in India. He's over there and just telling us what's going on in the ground and the pace of development and the companies that are emerging and some of the stuff that they're doing. It changed my perception on India, and I think I went home and was like, my next trip is going to be to India. So
nice.
We'll see if that conviction holds, but really exciting and inspiring interview.
Yeah. Anyway, so on Friday as well, we do a deep dive on all things bonds with Dr. Christian Bayliss. So if you're interested in that asset class that has been forgotten for the last decade but is now roaring back to life, make sure you tune in. But Ren, as always, we'll leave it there and we'll pick it up on Thursday.
Sounds good.